Hi everyone, I hope everyone's doing well. I'm recording this lecture video on before the Hurricane Lee hit or tropical storm or whatever it ends up being, so I hope everyone came out of it safe and healthy and happy. The next two classes, as I touched on in our first class, so September 18th and September 25th, the next two classes will not be in person. You do not have to be on campus for these. I will be out of the country for travel until the 26th. So what I'll be doing is pre-recording these two chapters, chapter 2 and chapter 3 lectures, and posting them on Moodle for you guys to watch. I will also be posting a separate video from this to go through some of the practice problems, and I'll be posting the solutions to those as well, so you guys can review all of those. As always, I would also advise everyone to read the book chapter to refresh yourself on all the specific details of the chapter and go through the other practice problems outlined in the syllabus. For any questions you guys have from these two chapters, where I will be out of contact of email until the 26th, please just write them down and send me an email whenever you guys think of your questions. And when I get back, I will go through all of them with you. And if everyone has a kind of common theme or common question they didn't quite get, we can kind of look through that in our next class, or I can even post another video then to kind of refresh everyone. So I appreciate you guys working with me here, and we're going to get through the next two chapters until we're back together after the holiday breaks. So with all that said, we're going to be looking at chapter 2 today, cost terms, concepts, and classifications. So the learning objectives for this chapter is 1, identify each of the 3 basic manufacturing cost categories. 2, distinguish between the product cost and period costs. 3, prepare an income statement including the calculation of cost of goods sold. 4, prepare a schedule of cost of goods manufactured. 5, explain the differences between variable and fixed costs. 6, identify the differences between direct and indirect costs. And 7, describe the cost classifications used in making decisions, such as differential costs, opportunity costs, and sunk costs. So, manufacturing costs. Manufacturing companies typically divide manufacturing costs into 3 different broad categories. We'll touch on all of them in the next few slides, but they include direct materials, direct labor, and manufacturing overhead. So an example of a manufacturing company is just any company that makes their own goods. I know that's kind of obvious, but I like to think of one of my clients, Protocase. They make custom enclosures out of metal frameworks and stuff like that, and all of their manufacturing is done on site here in Sydney. So they're not buying finished products from other companies and reselling it at a markup. They are making all of their own stuff and then selling it as it is to their customers. So the first one is direct materials. Materials that go into the final product are called raw materials. When I think of raw materials, I think of every physical component that makes up an end product. So everything you physically took to make, say, a bench is what makes up your raw material. But you can also split up raw materials into both direct and indirect materials. So a direct material are those materials that become an integral part of the product and that can be physically and conveniently traced directly to it. So to continue with my example of the bench, so a direct material for the bench I'm making, if it's a wooden bench, is the actual wood it took to physically make the bench itself. I can directly trace, okay, I took 4 2x4s to make this bench. These are the direct materials. On the other hand, indirect materials either cannot or it's not worth the time or expense or effort to trace the cost to the end product. We include indirect materials as part of manufacturing overhead, which we'll discuss more in the next few slides. But another example of an indirect material is, okay, I made my wooden bench. The wood is my direct material. Well, maybe my indirect material is the glue I had to use to glue down parts of it together to seal it. I'm not going to measure, say, it took 3 tablespoons of glue to work on this bench. It's just not worth the time or effort. There's no easy way to trace it. So we just kind of throw it into a pool of manufacturing overhead as opposed to the wood, which is very easy to trace how much wood actually came off our inventory lots to make the bench. So the next one is direct labor. Direct labor consists of labor costs that can be easily, both physically and conveniently, traced to individual units of a product. So a common example of direct labor is if I'm in a bench creating factory and there's someone on the assembly line that's building the bench for me. Their wages and however long it takes to make the bench will be direct labor hours toward the bench. So for example, if they get paid $15 an hour, it takes 2 hours to make a bench. Well, that $30, their total time of the wage they spent making the bench, will be their direct labor cost on that bench. On the other hand, labor costs that cannot be physically traced to the creation of products or be costly or inconvenient to do so are called indirect labor and are treated again as part of manufacturing overhead. So again, say in this factory that makes benches, I have a janitor who comes at the end of the day and cleans up all the wooden shavings from the assembly line afterwards and cleans up the area. While they're important to the product, because if they didn't do so, then the workers actually making the bench wouldn't have a clean workspace, wouldn't be as efficient. But I can't really trace how much time of that janitor's time cleaning the factory floor actually went into one specific project. So again, we kind of just spill that into the general manufacturing overhead. It's not convenient or easy to trace it to one product, so it just goes as an indirect labor cost. And lastly, we have manufacturing overhead, which I know I've touched on a few times now. Manufacturing overhead includes all the costs of manufacturing except the direct materials and direct labor. So this really is just kind of a catch-all bucket for every other cost that we can't easily directly trace to a specific product being made. As we said, the examples of this are indirect materials and indirect labor. Indirect materials used to support the production process, such as lubricants and cleaning supplies, anything like that used on a factory floor for any kind of manufacturing plant. Some more examples of indirect labor, like I said, are wages paid to employees who are not directly involved in the production work, such as a janitor, a maintenance worker, a security guard. They're all contributing to the end creation of a product, but we can't directly or easily trace these costs. And so what ends up happening with manufacturing overhead is we will pool all these expenses into one big pot, and we'll have to find some kind of way that makes sense for each individual manufacturing company to allocate this across their products. So what some people do is they will divide the manufacturing overhead by the total amount of hours per project, and that's how they'll allocate it. Well, if this one took, say we have $10 of manufacturing overhead and one project took 2 hours to complete, well, $2 of that 10 will go to that one project. And that's how we can kind of shift this manufacturing overhead to each individual product without directly tracing it. You could use different things such as labor hours, direct hours, machine hours, anything that makes sense as far as what eats up more of that manufacturing overhead. So our classifications of costs, so manufacturing costs are often classified as follows. So we can group together our direct material and direct labor into our prime cost. And basically all it means is these are the direct costs related to a product. And so these are really the two costs that come together that are just make up the prime expenses of this. On the other hand, if we look at our direct labor and our manufacturing overhead together, this is more of a conversion cost. And what we mean by conversion is that when we group these two costs together, so the labor and any manufacturing overhead, like we said, so like small indirect labor, indirect materials, these costs are really responsible for converting the raw material, our direct material, into a finished good. So we can classify our direct cost, direct labor, and direct material as our prime cost, our first kind of lump cost of what it's actually going to take to make the product based on the materials and labor required. And then we can look at our labor and manufacturing overhead as our conversion cost together, as it's what's transforming that direct material into the final finished good. So overtime premiums, you might be asking yourself, what is an overtime premium? So some of you may have worked in retail or something like that. An overtime premium is just an extra amount of money added to your base salary for working, say, overtime. So maybe you'll get another 0.5 of a dollar for every, on your salary rate for every extra hour you work during the night. Or say you're working during a statutory holiday, you might get an extra double time your salary for working those hours. So when we look at overtime premiums in this context, overtime premiums for all factory workers are usually considered to be part of manufacturing overhead when it affects all production. So for example, in my continuing example of the benches, so say in my bench factory in this world, The fall is a really busy time for us at our factory because everyone wants to give a bench away for Christmas to their loved ones. So between September and October, we ask that our staff work an extra 2 hours every night and say we're going to give them an extra $2 on top of their normal hourly rate to work these extra hours. Well, whereas impacting every product that'll go through our manufacturing company, we can't really directly tie it to one product. It's just across the whole firm. So this will all just go into the manufacturing overhead. So their normal direct labor hours, their normal salary will still go to their products, but all this extra premium time will be lumped into manufacturing overhead. Now, on the other hand, if a product-specific overtime premium is paid, it is part of our direct labor. And so what I mean by a product specific one is if, for example, we had a customer come in last minute and they say, oh my gosh, I need this done and manufactured by the end of the week. It would normally take us 2 weeks to make it. We only have 1 week to complete it. And so we're going to have to put extra staff on in order to complete it. Well, we're going to charge to the product this extra time because it's very specific to one job we're doing. So overtime premiums can either go to manufacturing overhead. If it's a whole kind of manufacturing wide, we just have a busier time, we're paying out additional premiums. But it can also go to direct labor if we can directly tie it to a specific product or even a specific job that we're trying to complete. So now we also have our non-manufacturing costs. These include marketing or selling costs, so costs necessary to get the order and deliver the product. So sometimes they'll call this order getting and order filling costs. So if you think of marketing costs, there's the classic advertising, paying wages to our sales staff, travel expenses for sales staff in order to make sales, all those kind of things. Selling costs can include the cost of packing the product, shipping it to the customer, holding products in warehouses. So all of these are related to getting the cost out and to our customers, but they aren't manufacturing. Same thing with administrative costs, so all executive, organizational, and clerical costs. So I like to think of administrative costs as everything else. So it's not manufacturing, it's not marketing or selling. It includes our HR department, our human resources, our accounting, the cost of our managerial staff that aren't directly tied to production. So any of these other costs will fall into our administrative costs required to make the product happen, but it's not directly linked to the manufacturing process, and it's not directly linked to marketing or selling costs of the product. So we can look at further classifying costs between our product costs and our period costs. So I'm going to look at period costs first because it's a little bit easier. So a period cost is anything that does not include costs directly attributed to the products. So this is our selling and marketing and our administrative costs. So everything around, every other cost in the organization except for those manufacturing costs it took to make the product. And what's easy about these is we expense them as they incur. They go right onto our income statement. But if we look at our product costs, so our product costs include direct materials, direct labor, and our manufacturing overhead. So everything it took to physically make or acquire a product. These instead follow what we call a matching principle. So the matching principle states that costs incurred to generate a revenue should be recognized as expenses in the same period that revenue is recognized. So if a cost is incurred for something that will be eventually sold, then that cost should only be recognized when the sale actually occurs for the product. And that's why we call them product costs. So as you can see below, down here, my fancy laser pointer, when we first make a product cost, it first sits as a finished good in our inventory. And our inventory sits on our balance sheet. And until the sale actually occurs, when this sale does occur, it goes and hits an expense as our cost of goods sold. So we make our sale, we get our money, we take it off our balance sheet, and we expense it for how much we took out of our inventory. And so we call it a product cost because everything related to this product selling. Period costs aren't dependent on the sale of the product. So those selling and admin costs are related to HR, accounting, so all that stuff will happen no matter when or where we sell the product. They're incurred regardless as they contribute to the ongoing function of the organization, so they're recognized in the same period they're incurred. So technically, if we made a bench this year, we could technically not sell it until next year for whatever reason. Say in our fiscal year is December 31st, maybe we made it December 28th, it didn't sell until January 7th. So we don't want to recognize the expense for selling it yet because, well, we haven't made the money related to that cost yet. So we're going to wait, keep it on our balance sheet as inventory, and then recognize it into our income statement as an expense under cost of goods sold once it's actually sold. So just a summary of all these cost terms we just learned. We can start with our manufacturing costs, which are up here with my laser pointer. So these manufacturing costs are also called our product costs, and they can also be called our inventoriable costs, because as I talked about in the last slide, these are the costs that will first hit our inventory on the balance sheet and then move into the income statement as an expense under cost of goods sold once the product is sold. So these manufacturing costs or product costs are consisting of our direct materials, so materials that can be physically and conveniently traced to a product, such as wood in a table or a bench. Our direct labor, a labor cost that can be physically and conveniently traced to a product, such as our assembly line workers in a plant. Direct labor is sometimes called touch labor, so just a different word for it. And lastly, our manufacturing overhead, which are all costs of manufacturing a product other than the direct materials and direct labor, such as indirect materials, indirect labor, factory utilities, depreciation of factory buildings and equipment, all the stuff related to the production of that product that isn't directly traceable through the materials or labor falls in this manufacturing overhead. So that's a good one to know. It's not just our indirect materials and indirect labor, it can also be utilities related to the production facility we're making the product, and things like depreciation of factory buildings and equipment. So if we combine together, if we group together our direct materials and direct labor, we can also call this our prime cost. And if we group together our direct labor and our manufacturing overhead, this can be our conversion costs, as it is the conversion of our direct materials into the final product. And then down below, we have our non-manufacturing costs, also called our period costs, which are immediately recognized as they are incurred. They are our marketing or selling costs, so all costs necessary to secure customer orders and to get the finished product or service into the hands of the customers, such as our sales commissions, advertising, and depreciation of delivery equipment and finished goods warehouses, so not any of our buildings or anything required in our factory plant. And as well as our administrative costs, which are all costs associated with the general management of the company as a whole, such as our executive compensation, executive travel costs, secretarial salaries, research and depreciation of office buildings and equipment. So as you can see, for depreciation is a bit of a tricky one because it can kind of fall into all three different buckets. But you have to think about what the building or equipment or whatever is used for. So if it's used for manufacturing, it's going to get captured in manufacturing overhead. If it's related to sales, deliveries, marketing, anything like that, it's going to go in our marketing or selling cost. Or if the depreciation is related to our normal office buildings, it'll go into our administrative costs. All right, so it's time for our first quick check. So which of the following costs would be considered a period rather than a product cost in a manufacturing company? So I'm going to give you a second to pause this video and give a crack at these yourself. So remember, our product costs are anything related to directly making the product, so our direct materials, direct labor, and manufacturing overhead. And our period costs are everything else, including our marketing, selling, and administrative costs that aren't directly tied to the product. So feel free to pause now, give it a check, and then when you unpause, we're going to look at it together. And we're back. So let's take a look at these together. I'm going to get out my handy pen here. So first one is our manufacturing equipment depreciation. So this would be a product cost. And the reason for that is that it is depreciation related to the actual manufacturing equipment related to production. So because of that, it would be allocated in our manufacturing overhead and would be classified as a product cost. So if we're looking for period costs, this is not one of them. Next is our property taxes on corporate headquarters. So this would definitely be a period cost. This is related to our administrative costs. It's just the property taxes on our administrative building, where maybe the executives or accounting or HR staff are working. It doesn't specify anything about selling or marketing, but either way, it is definitely a period cost. It cannot be directly attributed to the product. So this is a period cost. Next, direct material cost. So this is definitely a product cost. It is one of the three we talk about: direct materials, direct labor, and manufacturing overhead. This is directly related to the materials used that we can trace in a product. So this is definitely a product cost. Next, the electrical cost to light the production facility. So this one's a bit trickier, but it would in fact be a product cost. And the reason being is that this lighting cost is one of our utilities, and it's directly related to the production facility making our products. So we would lump this in with our manufacturing overhead. So this would also be a product cost. And lastly is our sales commission. So this is related to our marketing and selling. So this would definitely be considered a period cost. We cannot directly attribute this to any of the products. So for this answer, our two period costs are our property taxes and our sales commissions. So next we're going to look at cost classifications on the financial statements. So financial statements prepared by a manufacturing company, like I said, anyone that makes their own goods to sell, are a little bit more complex than the statements prepared by a merchandising or a service company. So manufacturing companies must account for the production of its goods as well as the marketing of them. So manufacturing companies therefore have many costs that do not exist in a merchandising or other service company. Merchandising companies simply purchase goods from suppliers they resell to their customers as opposed to actually making them. So if we take a quick look at how this actually breaks out on a balance sheet between two different kinds of companies. So if we look at our merchandiser company, so their current assets on their balance sheet, as you guys will all remember from last term's financial accounting. So they're going to have cash, receivables, prepaid expenses, both are going to have the same thing. And then a merchandiser is just going to have their merchandise inventory. So this is what they actually would have bought from another company that would have made it, and is sitting as inventory on their balance sheet that they're going to now sell to the next customer. And they can just lump it all into this one big inventory product because everything is finished and ready to be sold as it was purchased fully completed. But if we look at the manufacturer and their inventory, well, they're going to have to break it up a little differently because as they're the ones making it, and at any given time during the year or day or week, all of their inventory will be at different percentages of completion. So they're going to have their raw materials, so stuff they have on the shelf that they haven't even started processing into their end product yet. They're going to have work in progress or work in process, so things that are partway built. So maybe someone started building it. If it takes, for example, it takes 2 days to make one product, well, maybe they are in the 1 day time frame, so it's not complete yet. So it's our work in progress. And then lastly, they'll have their finished goods, so things that are fully complete, ready to ship out, that are sitting in a warehouse now, ready to go. So they'll have a few extra items on their balance sheet than a normal merchandising company would have because they're making their own product. So now we're going to also look at the income statement. So cost of goods sold for manufacturers differs only slightly from the cost of goods sold for merchandisers. So for a merchandising company, if we're calculating our cost of goods sold, what we actually sold during a certain period, and it's helpful, let's just think of it for a year. You're always going to start with, all right, so what was our opening inventory? What was already sitting on the inventory at the beginning of the year? So in this case, it's 14,200. And then we're going to add our purchases. So where we are a merchandising company, our purchases are the actual inventory that we bought from someone else that we're going to resell to our customers. And when you add together your opening merchandise inventory and your purchases, you're going to have your goods available for sale. So this is everything, this is what we bought and what we already had that we're able to sell to our customers during this period, or we're able to sell to our customers. And the next step is to look at our ending balance. So at the end of the year, we're going to look at, well, how much inventory do we still have sitting in our shelves? And so say we had 12,100. Well, the total amount that we sold was this 236,250. So it's this 248,350 that we had available to sell. And if we take away what's already sitting at the end of the year, so what's left over, the difference between those two must be what we actually sold, so our cost of goods sold. So it's fairly similar for a manufacturing company. So we have our beginning finished goods inventory. So for us, this is what we have completed to sell as our finished goods. But instead of our purchases, we have our cost of goods manufactured. So the only difference between this is that instead of purchasing 234,150, we manufactured it ourselves in our own factory. And so same thing, if we add together our beginning finished goods inventory, so the things we had already completed and had sitting on our shelf, plus what we manufactured, we're going to get our goods available for sale of 248,350. If we take away our ending finished goods inventory, so what is still left at the end of the year, we're going to get everything that we sold during the year. So the big difference is the difference between our purchases, so what we purchased from a different company, from a merchandising company, and our cost of goods manufactured, so what we actually made as the manufacturing company. So our basic equation for inventory accounts is this below. So our beginning balance to inventory, whether it's our purchased inventory or if it's the one we created, plus our additions to that inventory, so the first two, is going to equal our ending balance, our ending inventory, plus our withdrawals from that inventory. So the beauty of this equation is that you can rearrange it kind of like an algebra equation. So if you have any of the three components of these four, you can figure out the fourth by rearranging the formula. So for example, if we consider the beginning balance, our beginning inventory as A, and forgive my bad handwriting, plus any additions as B, is going to equal our ending balance of C, plus our withdrawals of D. So we can rearrange this formula below using these different components to figure out the fourth one if we have all three. So if we're looking for D, we're looking for our withdrawals from inventory, so D. Well, we know that it's going to be equal to A plus B. And then we're going to have to move C over to the other side of the equation, so minus C. So if we were trying to find our withdrawals from inventory, which is D, we need to know our beginning balance, A, plus our additions to inventory, which is B, minus our ending balance, which is C. So we can rearrange this formula in any way to figure out one of the four, given we have the other three. So now we're going to put this to the test in the next few slides. All right, so time for our first quick check. So if your inventory balance at the beginning of the month was $1,000, you bought $100 during the month, so that's our additions, and we sold $300 during the month, what would be the balance at the end of the month? And so what I like to do when I read these questions is pick out some of the stuff in that formula we just talked about. So we can see the first one we see is at the beginning of the month, our inventory was 1,000. So our beginning inventory is $1,000. We bought $100 during the month, so our additions is 100. And we sold 300 during the month. So our withdrawal was 300. What would be the balance at the end of the month? So we are looking for our end balance. So if we think about our formula, so our formula was our beginning balance plus additions is going to equal our end balance plus our withdrawals, or what we sold. Withdrawals. So if we want to rearrange this formula for withdrawals, we're going to want our withdrawals on one side, and then we're going to put our beginning. Yeah, I know I have horrible handwriting. Plus our additions. And then we're going to have to move our end balance over on the other side of the formula, so minus our end balance, in order to figure this out. And the next slide, it will look a lot prettier than this. So as you can see, our answer is going to be $800. And how we got there is, so this $1,000 in this answer below was our beginning. And then we added our additions, just like our formula, and they rounded it first to be this 1100. And then from this 1100, so we added beginning plus our additions, we subtracted our withdrawals or what we sold. So what we sold, because it's a lot easier to write out than withdrawal. So what we sold was this $300. So 1100 minus 300 is our 800. So that represents our ending inventory balance for this month. So is end equals our beginning, 1,000, plus our additions of 100, minus what we sold, which is 300, to give us 800 total. So now for our manufacturing companies, we're going to look at how we get our schedule of costs of goods manufactured. So what does this do? It calculates the cost of our raw materials, direct labor, and manufacturing overhead used in production. It also calculates the manufacturing costs associated with the goods that we finished during the period. And we're going to look at this a little more in the next slide. So now we can start to look at our product cost flow. So how our product costs flow through the entire manufacturing process. So as items are removed from raw materials inventory and placed into the production process, they are called our direct materials. So as you remember, our raw materials are the things that we haven't begun any production process on. It is just sitting on our shelves. And so we can create a schedule for this. So we have our beginning raw materials inventory. So say if we're looking at our wooden benches, so this is the wood I already have sitting on the shelf. I haven't touched it yet. It's just been sitting there ready to be used. It's my beginning inventory of this raw material, plus any of the raw material I purchased during this period. So say I bought a bunch of new wood. So the beginning inventory I had plus anything I purchased is going to be all the raw materials I have available for use in my production. So I can use all of this to make whatever I'd like. And if we take away the ending raw material inventory, we can see how much raw material I actually used in production during this time period. So the time period can be whatever you want, it could be year. So say during the year, this is how much raw material I actually used in production. And it is this, as it moves from raw materials that were actually used, this is going to be our direct materials we actually used during manufacturing. So this little schedule for raw materials is a way to calculate our direct materials. So as you can see, we got our direct materials using this raw material schedule over here. So this number flowed over here to our direct materials. And we're going to add our two conversion costs. Remember, our conversion costs are costs incurred to convert the direct material, so right here that came from a raw material budget, into a finished product. So we're going to add our direct labor and our manufacturing overhead to get our total manufacturing costs, or our total product costs. So you can see this continues to flow. So our total manufacturing costs here will now flow into our schedule for all of our work in progress costs. So again, we start with our beginning work in progress inventory. We're going to add everything we actually made, so our total manufacturing costs. And this is going to give us our total work in progress for this whole period. So all manufacturing costs incurred during the period are added to our beginning balance of our work in progress. And on the next slide, you'll see how it flows further. So then as you can see, so we had all of our total manufacturing costs go over here into our total work in progress for the period. All the costs, we're going to take away our ending work in progress. So this is what we end it with at the end of the period. So the difference between all of the work we worked on, so total work in progress during this period, minus what's actually sitting in inventory. So think what's actually sitting in a warehouse half completed, is going to be what we actually manufactured into finished goods. So that difference is every product that was fully finished. And what's going to happen is our costs associated with the goods that are completed during this period, so they aren't sitting in that work in progress anymore because they've been actually completed, are transferred to our finished goods inventory. So for the last step in this process, you can see our work in progress. So like the last slide, we have our cost of goods manufactured. So everything we actually made into a finished good during this period is going to move over to our finished goods schedule. And every schedule looks very similar. It always has our beginning amount, so our beginning finished goods inventory, what we started with. In this case, for our finished goods, we're going to move over everything we made. That's a finished goods now. So we made all this inventory to be sold. And those together is everything available for sale. So all of the finished goods we had and made is what we can sell during the year. And if we take away what was left sitting in our finished good inventory during the year, we'll have everything that we sold during the year, our cost of goods sold. So this is a good summary of how actually all of the costs will flow between the balance sheet and into the income statement eventually. So first we have our raw material purchases. So like we said, if we bought wood to make benches, so the cost of raw materials purchases is going to hit our balance sheet first as our raw materials inventory. And then as things are made, the direct materials used in production are going to move into our work in progress inventory, which is still in the balance sheet. Our work in progress inventory is also going to be collecting costs from our direct labor and our manufacturing overhead, because in work in progress, that's when we're actually making the finished goods. So we're creating the products in our work in progress. As they're completed, so our cost of goods manufactured, we're going to transfer it down into our finished goods inventory, which is also still in the balance sheet. And now it's going to sit here on our balance sheet in our finished goods inventory until we actually sell the goods. And once the sale is made, so once we sell our bench, we're going to move it from our inventory into our income statement as an expense for our cost of goods sold. As you can see down here as well, so that's all our product costs up here, our raw materials, our direct labor, and our manufacturing overhead. And then at the bottom here, we have our period costs. If you remember, we were talking about earlier, which is our selling and administrative costs. And so they're going to immediately hit into the income statement as our selling and administrative expenses. So this is just a good summary of how all these flows in our process flow from the balance sheet for the product costs and eventually into the income statement through cost of goods sold, and how our period costs, which is our selling and administrative, will hit the income statement right away. So again, this is just a good summary of the flow. I know it looks a little confusing, but we'll walk through it. So number one, our materials, labor, and overhead costs are debited to work in progress as they are incurred. So as you see, we have our direct materials, our direct labor, and our overhead, all of our product costs. So together it's going to be $800,000. They're coming to the balance sheet. First is the raw materials, and then they're going to move together into the work in progress inventory. So that's us actually using all three of these costs to make our product. And then they're going to go down. When goods are complete, the related costs are transferred from our work in progress down to our finished goods. So here we go. They're moving down into our finished goods inventory. They're going to sit here until they're sold. And when they're sold, so when goods are sold, the related costs are transferred from our finished good inventory to our cost of goods sold. So you can see this 800K has made it through all of the inventory expenses and it's hit our cost of goods sold for the 800K. And on the other side, we have our selling and administrative costs. So when these costs are always expensed in the period incurred. So for this period, they were $150,000. So these selling and administrative costs are going to skip the balance sheet and go directly over to our income statement. The 150K is going to hit selling and administrative expenses. And so we have a summary of our cost classification. So this slide's a little confusing because some of them we've covered already in this lecture, some we're going to cover in the next few slides, so just bear with me. So the purpose of our cost classification for the first one, so for preparing external financial statements, we care about those product costs we've talked about. So their product costs are inventoriable because if you remember, they're going to hit our balance sheet first as inventory and then they are expensed as the product is sold, and they consist of our direct materials, our direct labor, and our manufacturing overhead. And then we also have our period costs, which are expenses they are incurred because they're not tied to a specific product. And they consist of our non-manufacturing costs, which are our marketing or selling costs, and our administrative costs. So the next few ones we haven't talked about yet, we'll summarize here. So when we're trying to predict cost behavior in responses to changes in activities, so how are costs going to change when our activity changes or what we're doing changes? We're going to look at our variable costs and our fixed costs. When we're looking to assign cost to cost objects, such as departments or products, we'll look at our direct and indirect costs. And when we're making decisions, we'll look at our differential costs, our sunk costs, and our opportunity costs. So again, we haven't gone over these ones yet, so we'll cover them in the next few slides. But first, let's do a quick check. So our first question is going to be, beginning raw materials inventory was 32,000. During the month, 276,000 of raw material was purchased. So our purchases. A count at the end of the month revealed that $28,000 of raw material was still present. So what is the cost of the direct material used? So again, we can still use our same formula to figure this out. So we're going to want our beginning plus our additions is going to equal our end plus our, in this case, instead of withdrawn or sold, we're going to put used. Because we want our direct material used. So we're going to say our direct material used should be our beginning plus our additions minus our end. And the next slide, we can see how this breaks out. So as you can see, the answer is our beginning raw materials, which was $32,000, plus our purchases, which was our $276. So our beginning and our purchases equals our total raw materials available. So our 308, so we add those together. And if we're looking for what was used in productions, we need to take away our end inventory of 28,000. So the 308 available for production minus what was left of 28,000 is going to give us our total raw materials used in production of 280,000. All right, so our next question is, direct materials used in production totaled 280,000. Direct labor was 375,000 and factory overhead or manufacturing overhead was 180,000. What were the total manufacturing costs incurred for the month? And our answer is 835,000. So as we know, manufacturing cost is the same as our product cost, which is made up of all of our direct materials at 280, all of our direct labor at 375, and all of our manufacturing overhead at 180 for a total manufacturing cost for that month of 835. All right, so for the next one, we have our beginning work in process was 125,000. Our manufacturing costs incurred for the month were 835,000. There were 200,000 of partially finished goods remaining in work in progress inventory at the end of the month. What was the cost of goods manufactured during the month? So again, we can use the schedule or we can kind of look at our formula to give us a little bit of a hint of where to go with this. So our cost of goods manufactured will equal our beginning plus our additions plus, or sorry, subtract, get rid of this little line, minus our ending. So in this case, our beginning work in progress was 125,000. We incurred or we added 835,000 of costs, and at the end of the day, there was $200,000 remaining. So if we look at the next slide and see our answer is going to be 760,000. So just to recap, as you can see, so I like to do it in the formula myself. I find it easy to keep track of, but these schedules work great. So we had our beginning work in progress inventory was 125,000. We added all the costs incurred for the period, which is the 835, which equals our total work in progress during this entire period of 960. So they add them together here. And then in order to get what we actually manufactured in the period, we have to take out our ending inventory balance of 200,000 to get our 760. Okay, and so for our last quick check on these, we have our beginning finished goods inventory was 130,000. The cost of goods manufactured for the month was 760,000. And the ending finished goods inventory was 150,000. What was the cost of goods sold for the month? So if we want to recreate this chart we're used to, so our beginning finished goods was this 130,000. So I'm just going to use our shorthand here. Our cost of good manufactured for the month was 760,000. So think of our chart, how it flows. We're looking at our finished goods. So our cost of goods manufactured is going to be our additions, because everything that was manufactured this year is going to transfer into our finished good inventory. So this 760 is going to be our finished goods, or sorry, our cost of goods manufactured, our additions. So that is going to be 890. And so then that's going to be our total finished goods available for sale. But we're looking for total cost of goods sold. So we want to see everything that was sold. So this is everything we have available to sell. We want to figure out what was actually sold. So we're going to have to look at our ending finished goods. And by seeing what was left at the end of the month, so it was 150. So for this one, we want to add them together. For this one, we want to take it away, and that's 740,000. So this is going to be our cost of goods sold. So again, we're looking at our beginning finished good inventory. We're going to add everything we manufactured, because that altogether at that 890 is everything we have available to sell to the customer. That's all of our finished goods that we completed this month or had on hand. And then to figure out how much of it we actually sold, we're going to take away our end finished good we didn't sell that's still sitting in the warehouse, and then we can tell that we had 740 sold during the month. All right, so now we're going to look at cost classifications for predicting cost behavior. So how a cost will react to changes in the level of activity within the relevant range is their cost behavior. So we have two kinds of costs we generally are looking at. One is variable costs. So variable costs will change when the activity changes, and fixed costs will remain unchanged when the activity changes. And we're going to explain a little bit more about them in the next slide. So let's first look at variable costs. So like I said, a variable cost will change depending on the activity. So the example here is your total texting bill is based on how many texts you send. So think back to if you remember having minutes on your phone, where let's say every text costs you, I don't know, 5 cents to send. So the total texting bill you would have is going to change for the number of texts you send. So if it costs 5 cents to send a text and you send 5 texts, well, that's 25 cents. If you send 6, that's 30. It's going to keep going up the more your activity changes. So the other important thing about variable costs to know is that variable costs, their cost per unit, will remain constant. It won't change. So in our example, the cost per text sent is constant at 5 cents per text message. So it doesn't matter how many texts you send, the cost for each text is still going to be 5 cents. You can see it's just a straight line. So it doesn't matter if I send 50 of them, that cost per individual text will always be the same. So what we have to look at when we're looking at a variable cost is what is the activity base, or what is the cost driver? And a cost driver is a measure of what causes the incurrence of a variable cost. So in the example we just showed, the cost driver was the number of texts we sent. So every time we sent a text, the cost would go up. That was driving our cost. And this can be different in all kinds of different situations. So we can see maybe in a factory, so every unit we produce is going to be what drives our cost. It could be our machine hours, of how long a product's actually on a machine is driving the cost. Labor hours, miles driven. So think of your car. So the more miles you drive, the more gas you're going to have to pay. So these are all the cost drivers. So then on the other side of variable costs, we have fixed costs. So a fixed cost stays the same. It stays constant with activity. It won't change based on how much activity you have. So for example, in this case with our cell phone, we've updated to the year 2023, and your monthly contract fee for your cell phone is fixed for the number of monthly minutes in your contract. So the monthly contract fee does not change based on the number of calls you make. So let's just say like most normal phone plans, you have unlimited call and text. So as you can see below, so the number of minutes we use within the monthly plan, or however many calls or texts we make, the cost is going to be the exact same because it's a fixed cost. If it was $300, that's a pretty expensive phone bill. If it was $300 for the whole month or for 3 months, it doesn't matter how many calls or texts we make, we're still going to pay $300. So what we're looking at then is that while a fixed cost overall won't change based on activity, the cost per unit will actually change based on how much you use it. So within this monthly contract allotment, the average fixed cost per cell phone call or per text or per call decreases as more calls are made. So think of that. So say our monthly bill is, let's bump it down to $100, right? And so say during the month you made 1 call. So your cost per unit or your cost per call, if you did, well, 100 divided by 1 is going to be 100. So on average, it costs you, for every call you made, $100. But if during the month you made 2 calls, well, now it's going to be $50 per unit for calls. So every time you increase the amount, your cost per unit is going down. Even though your fixed cost, you're still paying $100 on a per unit basis. The more you use it, if we went down to 3 and 4 and 5, it's just going to keep getting lower and lower. So the relevant range, so all you really need to know about relevant range is that this is the range of activity within which the assumptions about variable and fixed cost behavior are valid. So all that means is that this is the range in which we assume that everything variable, as activity increases, it will increase, and the cost per unit will stay the same. And in this range as well, the fixed cost will stay the same no matter the activity, but per unit will change. So all those things we just talked about our assumptions about variable and fixed costs, this is the range in which they are true. Once we go outside of these ranges, there may be changes, but just know this is what we mean by relevant range. So there is another cost called a mixed cost, which contains elements of both a variable and a fixed cost. So I like the example of think of a sales staff member that works on commission. So they'll earn a base salary. So every year they have a fixed salary. So say it's $40,000. But let's say for every product they sell, they'll get a 3% commission. So if you're calculating their total cost of their salary to the business, you'll have a fixed element, which is their annual salary that stays the same no matter how much they work. But then you'll have a variable portion related to the commission they were paid out based on how many products they sold. And you can think about a mixed cost with the formula of, so it's going to be the variable cost times X plus the fixed cost. And so what I mean by this is your mixed cost is going to be your total fixed cost, just as it is, plus your variable cost per unit. So say this was $5 times the number of units you actually sell. So to summarize the variable and fixed cost behavior, we can see the behavior of cost within that relevant range. So for variable cost in total, the total variable cost changes as the activity level will change. So the more activity you have, the more cost you're going to have. But on a per unit basis, it'll remain the same over that activity range. So think of the text messages. It's going to be $5 per text or 5 cents per text. That's not going to change, but the more text you send, the higher your variable cost will be. And then on the other hand, our fixed costs, our total fixed cost remains the same even when the activity level changes in total. But on a per unit basis, the average fixed cost per unit will go down as the activity level goes up. So again, think for example, if we're paying $100 per month for every text we send, the fixed cost is going to remain totally the same. We're still going to pay $100, but on a per unit basis for every text you send, your cost per unit is going to go down. So let's do a quick check. So which of the following costs would be variable with respect to the number of cones sold at a Baskin-Robbins shop? There may be more than one correct answer. So let's take a second and take a look at these. So if we look at A, so the cost of lighting the store. So think about that. If you sell more ice cream at this Baskin-Robbins, sell more or less ice cream, is it going to change the cost of our lighting? The answer would be no. This is a fixed cost. There's going to be a fixed amount of utility bill you're going to have to pay each month. So it's not going to change based on how many we sell. So this is not a variable cost. Next, the wage of the store manager. So again, it's going to be a little tricky, but they didn't indicate any commission on the sale of the store manager. So this is the annual salary. Again, it won't change based on the number of ice creams sold. So this will be a fixed cost, and it is not a variable cost. Next is the cost of ice cream. So think of it. For every ice cream we sell, will the cost of ice cream have to go up? The answer is yes. So think about it. The more ice cream we sell, the more ice cream we're going to have to buy. So we're going to have to keep replenishing our ice cream. So say it costs us $3 per cone to put ice cream, we're selling them for $5. Well, then every time we sell an ice cream, the cost of the ice cream we sold is going to keep going up. So if we sell one, it'll be $3. If we sell two, it'll be $6, and so on. So this will change with activity. It is a variable cost. And the last one, the cost of napkins for customers. So same idea. We're going to be using napkins as we're giving out ice cream. So let's just assume that for every ice cream we sell, we give a customer a napkin to clean themselves up with. So the more ice cream we sell, the more napkins we're going to have to give out. So the cost for napkins we've sold are going to keep going up with respect to the number of cones we sold. So this is also a variable cost. Assigning cost to cost objects. So this is just a short kind of section. So a cost object is any unit of analysis for which cost data are desired, including products, customers, jobs, and organizational subunits. So for assigning cost to cost objects, costs are classified as either direct or indirect. And so as we've already discussed before, so direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. Examples are direct material and direct labor, which we've talked about. But again, direct material is the actual physical materials required to build a product, and the direct labor are the direct wage hours needed to build it for, say, a staff member on an assembly line in a factory to actually make a product. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other cost objects, such as our manufacturing overhead, which is, say, the wages or time of other staff employees that contribute to the production facility, glue, utilities, supplies, depreciation on factory objects, all that stuff. So now we're going to look at costs in a bit of a different way again. So cost classifications for decision making. So for every decision involves a choice between at least two alternatives, and only those costs and benefits that differ between alternatives that are relevant in a decision. All other costs and benefits come in and should be ignored. So that makes a lot of sense. When you're deciding what to do, if it's going to cost the same amount of money to walk down to the park and swing on the swing set and walk to the beach and go for a swim, well, the cost of transport isn't going to be a decision because it's going to be free to do either one. You're able to walk, it's walking distance. But if you would have to buy a pair of swim shorts to go to the beach, well, that would cost you, let's say, $15. But you don't have to buy anything to go to the park and swim in the swing set. Well, now you have a cost alternative. There's two different costs associated with it. That's going to be $15 to go down to the beach and get your swim trunks and do all that, or it's going to be $0 to go to the park. So we only want to look at costs or benefits that are different between our two alternatives. We don't care about the ones that are exactly the same because they won't impact our decision either negatively or positively. So like I said, we can look at differential cost and revenue. So a difference in cost between any two alternatives is known as a differential cost. A difference in revenues between any two alternatives is known as a differential revenue. A differential cost is also known as an incremental cost, an increase in cost from one alternative to another. So sometimes when we're looking at two decisions, we call it an incremental analysis to see which one makes more sense from a financial point of view to take. So we also have opportunity costs, which are potential benefits that are given up when one alternative is selected over another. So the example is, say you were not attending university, you could be instead going out and earning $15,000 per year at a job. So your opportunity cost of attending college for 1 year is $15,000. So if that was the case, so you'd look at your options and say, well, I'm foregoing the benefit of working and making $15,000, but on the other side of your alternative of going to universities, you're hoping, well, after my time at university, I'll have the ability to get a higher paying job. And so in the long run, it is worth foregoing this immediate benefit for a long-term benefit. So, but that is what opportunity cost is the benefit you're giving up when you select an alternative. Doesn't mean it's better or worse necessarily, it's just what you've given up by choosing a single alternative. And finally, our last cost is the sunk cost. So a sunk cost has already been incurred and cannot be changed. Now or in the future, they should be ignored totally when you're making decisions. So for example, you bought a car that cost $10,000 2 years ago. The $10,000 cost is sunk because whether you drive it, park it, trade it, or sell it, you can't change the fact that 2 years ago you spent $10,000. So say today you were going to sell it for $5,000. That's fine because that could be an incremental revenue as a potential benefit. We could sell the car for $5,000, but you wouldn't include the fact that you had bought it for the $10,000 2 years ago because you can't change anything about it, so that shouldn't impact your analysis. That happened in the past. It's a cost that's already been incurred and shouldn't be considered when debating your two alternatives today. So let's do some quick checks. So suppose you were trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision to whether you drive or take the train to Portland? And so the answer is yes, the cost of the train ticket is relevant. And the reason is that we can assume that the cost of you driving to Portland and using your own gas in your own car would be pretty different from taking the train. So I'm not really sure how much a train ticket is, but let's say it's $50 for the train ticket down to Portland, but say it's going to cost you $100 to do a round trip in your own car for gas, and that's not including the fact that you're doing your own wear and tear on the vehicle. So whether that train ticket is higher or lower than the cost of your round trip in your own car, it's going to impact your decision on which one to take, because you're going to always want to take the most cost-effective one for yourself. And for our next quick check, we have, so suppose you were trying to decide whether to drive or take the train to Portland to attend a concert. So same idea, you have ample cash to do either, but you don't want to waste money needlessly. Is the annual cost of licensing your car relevant in this decision? So the answer is no. The licensing cost is not relevant because regardless if you go to Portland or not, you are still going to have to pay the annual cost of licensing your car. That's just the part of having your car is getting your licensing, paying insurance, all that stuff. So whether you drive the car or not at all, or you drive it everywhere, go to Portland, you will still incur the cost of licensing just to operate the car at all. So it wouldn't impact your decision because it's not a different cost. You will incur that cost no matter what you do. So we shouldn't factor it as a relevant factor in our decision making for this. So now suppose that your car could be sold now for $5,000. Is this a sunk cost? Now think about this one, and then we'll flip to the next slide and see that no, it isn't a sunk cost. And the reason this isn't a sunk cost is because we're looking at the incremental revenue we could get from selling our car now. So think back to the concert. So instead of, so if the train ticket happened to be more expensive than driving, but we were going to look at selling our car if we were going to take the train for whatever reason. Well, now if we're going to get an incremental revenue of $5,000 compared to paying the train ticket, well, then now maybe taking the train makes more sense because we have this extra revenue to help offset the cost. So it's not a sunk cost because if you remember, our original cost of our car was $10,000, and that's in the past and it's a sunk cost. But now we're looking at what revenue we get in the current time if we sell it now. So this will impact our decision today. So to summarize, we have our different types of cost classifications we learned about. We looked at financial reporting. We were looking at our product cost and our period costs. So remember, the product costs were our direct materials, direct labor, and manufacturing overhead. And then we had our period costs, which were our selling and marketing costs and administrative costs. We also looked at predicting cost behavior, and we looked at our variable and fixed costs. And we looked at assigning cost to cost objects by whether they were direct or indirect. And then lastly, we looked at our decision-making costs, whether they were differential costs or differential revenues, opportunity cost, and sunk cost. So to summarize again, the manufacturing costs can be divided into three categories: our direct materials, direct labor, and manufacturing overhead. Non-manufacturing costs are classified as either marketing, selling costs, or administrative costs. And when we're valuing inventories and determining expenses for the balance sheet and income statement, costs are classified as either product costs or period costs. Cost of goods sold is calculated by adding the cost of goods manufactured to the beginning goods inventory and then deducting the ending finished goods inventories. Remember that formula we went over? To predict cost behavior, managers commonly classify costs into two categories, variable and fixed. To assign cost to cost objects such as products or departments, costs are often classified as direct or indirect. So that is the end of chapter 2. I will be putting up some of the recommended problems for you guys to try and going through some of them with you. This kind of stuff is really great to get the extra practice in. You want to repeat it over and over again so the math makes sense, and those formulas you can just kind of pull out of your back pocket, and any question I throw at you will be easy as pie. So thanks guys for listening, and I hope you have a great day. And if you have any questions, just like I said, after this lecture I'll be out of town, but I'll be back on the 26th, so please email me if there's any parts of this chapter that you needed more help with, and we can look at reviewing it together when I get back. Thanks, guys.